This audience, this lively audience, reminds me of an event that occurred in Toronto this past summer, last summer. And this wealthy Torontonian had a party. And as the Rolls Royces and the Mercedes-Benz drove up, the valet service ushered the cars to the parking lot. Now, when the party got to its highest crescendo, the mischievous host said to his lieutenant, "Turn the music down. We're going to have a contest here tonight. So bachelors, all of you, come on over to my indoor swimming pool. Line up. We're going to see who can swim across the pool. And the first man to alight from the pool unscathed can either choose my beautiful daughter's hand in marriage or $1 million. So gentlemen, line up, on your marks, set." Just before he said go, he said to his lieutenant, "Open the gates." And in swam the killer sharks. Then he said, "Go." No one moved. "Go." No one moved. All of a sudden, this one fellow was in the pool, flailing away, sharks jumping at his heels. Miraculously, he alighted from the pool unscathed. So panting now, he went over to the host, and the host said, "My gallant Victor, congratulations." Now, which would you prefer? My beautiful daughter's hand in marriage or $1 million? He said, "Neither. I just want to get my hands on the SOB who shoved me into the pool." So, ladies and gentlemen, we aren't here to shove anybody into doing anything. But already, what I'm here to do today is suggest that we are in the pool, and the sharks that are chomping at our heels are a commoditization of our industry, the securities industry. Products that invariably can be bought less expensively on the internet, and hence making us more irrelevant. The sharks that are chomping at our heels would be bad investment products, low-grade investment products, ventures, whereby the risk is truly high. Those are the sharks that are chomping at our heels, and those are the sharks that will ambush our career. So the question is, how do we make sure that the shoals that we have to navigate will get to the other side intact? That's the question. So we're going to start from empirical, fundamental principles. Everybody in this room would love to have a long-term sustainable business, right? Everybody. Whether you are a dealer or you are an advisor. Am I right? Let's start from that. Am I right? Well, there are three things that we all have to do phenomenally well. The first is, to have a long-term sustainable business, we have to make sure that our reputation is built and burnished every single day. So we have to build the best reputation possible. Because having a great reputation is what gives you access. Secondly, we have to do an excellent job at making sure that everything we do is the centerpiece of decision making, considers differentiating ourselves in the marketplace. Whether we are a dealer or whether we are an advisor, we have to differentiate ourselves. And thirdly, not necessarily in order of importance, but everything we do has to put the client first. We really have to make sure that we are addressing clients' needs honestly and truly. We have to do that. So we just can't be salespeople. Those days are long gone. So early in my career, I started off with Investors Group, knocking on doors in 1977 at the age of 26 years old, selling mutual funds in 1977. But before I got fully in stride, I asked myself the question, and I think this is still today a relevant question, 36 years later. When I sit in front of a client, what is the client really asking of me? What is the client asking of us when we sit in front of a client? What? The client is saying, look, I'm going to give you some capital, and I'd like for you to make sure that, number one, you protect my principal. Don't lose my money. That's the first thing. Secondly, I want to make sure that with this capital that I'm going to give you, you are sure that over time I'll get a long-term real rate of return after taxes, inflation, and currency depreciation on that capital. And thirdly, I want to make sure that this income, this investment that you're about to make for me has some potential to give me some income. And lastly, I want for it to minimize my taxes. Those are the 4 things every single client would love to have done. We do, right? Am I right? So, if we do a good job at optimizing those 4 variables, the outcome will be we'll create wealth for the clients. So therefore, what the client is saying is, please, advisors, help me create wealth, basically, right? So if the clients are saying to us, help me to create wealth, what is the natural first step from that mandate that the client has just given us? Help me to create wealth. What's the natural first step? Is the natural first step to find out if there is a formula that once you follow this formula rigidly, the natural outcome will be wealth? Isn't that the first step? No? So let me ask, how many advisors are in here today? 100? Let me ask any advisor, please tell me, if your prime responsibility is to create wealth for your clients, and your clients are saying, please create wealth for me, how do you do it? How is wealth created? Anybody can tell me that? How is wealth created? Because if I was a client, a prospect, that's the first question I'm going to ask of you. Tell me, what's your name, sir? Dax. Dax? Dax, you're probably saying, why did I sit in front? Dax, if I was a client, a prospect, you're not an advisor. Who is an advisor in here? No, I guess you won't have any advisors now. If I was a client, that's the first question I'd be asking. Wouldn't Dax? Isn't that the first question you'd be asking of your advisor? How are you going to create wealth for me? Isn't that the first question? How are you, Mr. Advisor or Ms. Advisor, going to create wealth for me? Tell me your methodology. I want to understand it. Yeah. I just don't want for you to say to me, trust me.
No, I would ask him, how are you going to do this?
Exactly. So Mr. Dax said, I would ask him, how are you going to create wealth? So suppose, any advisors in the room? None? Oh my gosh, where did you guys go? Okay, so Mr. Dax, if you're to ask your typical advisor, tell me the principles that you use to create wealth for your clients. That's a natural question. How many advisors will be able to give you an immediate and articulate answer? How many? How many in this room? Eh? I don't understand. Okay, so I tell you everything. So I'm not going to tell you anything about me. You want to tell me. So you tell me how you're going to create wealth. I don't need to tell you anything. I can go next door. I can go on the internet and buy. So you need my sale. So why do I have to tell you anything unless you give me a reason to tell you something? Right? So the point is, ladies and gentlemen, if our first responsibility is to create wealth, we had better make sure we understand how wealth is created. That's ABC, right? So that, as a young man, was my quest. My quest was, is there a formula that if you follow this formula rigidly, the natural outcome is you will create wealth? So ladies and gentlemen, this was 36 years ago. Is there such a formula? And if there is, would anyone like to know? Exactly. 100%. We're going to get back to that. Okay, so is there a formula? So that was my quest as a young man. 26 years old. So I read, I studied, and eureka. I came across this book in 1978. It was entitled The Money Masters. And as I was reading, this book chronicled the methodologies of the various American investors. So as I was reading, they were talking about these investors who made it in real estate by predicting where the market was going, these investors who made it in the stock market by predicting where the stock market was going, these investors who made it in the currency market. And I thought, oh my gosh, as an engineer, I'm a tactile person. So I have to feel it, taste it, understand it. So, and I I didn't have the confidence to think that I could create wealth by extrapolating from the squigglies of the past. I didn't have that confidence. So I was getting frustrated until I got to the chapter on Warren Buffett in 1978. And it resonated with me. So when Mr. Buffett was asked, Warren, how did you create so much wealth to the point whereby you started from zero and today you're worth $50 billion? Starting from zero, you didn't invent anything. He invested in other people's businesses, right? That's what he did. No different from us. So Warren, how did you do it? His response back then and his response today would be, to be successful over the long run doesn't require stratospheric IQ. Thank God for that. Unusual business insight or any particular inside information. What's needed, though, is a sound intellectual framework. It's a sound intellectual framework for making decisions. And secondly, the ability to keep one's emotions from corroding that framework. So that was my aha moment. Because all I had to do was to find a framework that made sense, and then I blindly stick to the framework. Whether things are great or things are in the dumps, I just stick to the framework. So we need two things, ladies and gentlemen. We need a framework, and we need the ability to not change the framework. And that's not too easy. So what's the framework? What did I garner from reading that particular chapter and also prior, the investigative work I did prior? I garnered that wealth is created by doing 5 things. 5 things. So, what's your name, sir? What's your name, sir? Chris. Are you an advisor? We found one. Okay. Chris. Okay, it's okay, Chris. We're going to ask some easy questions. So, Chris, think of any wealthy person in the world. Have we met before, Chris? Have we met before? So this is not a setup. Huh? But we have never met before. We have never met before. So, Chris, think of any wealthy person in the world, right? Have you thought of someone? Chris, I'm going to define to you the fact. Have we all thought of a wealthy person? The person could be in Timbuktu, it doesn't matter. Chris, I'm going to define to you the 5 things that person did to become wealthy. Now, what is the likelihood of me getting it 5 out of 5 right? High or low? I don't know, Chris. You could be thinking about anybody, right? So what's the likelihood? High or low? Low. So how about if I got it right, 5 out of 5? Then what would you see? Okay, Chris. Firstly, the first thing that person who you're thinking of did was to own a few high-quality businesses. Am I right, Mr. Chris?
Yes.
Thank you, sir. Am I right? The person you're thinking of owned or still own a few high-quality businesses. Am I right? Secondly, Chris, that person you're thinking of, I am sure, really understands those few businesses. Am I right, sir? Third, am I right, ladies and gentlemen? Thirdly, Chris, that person you're thinking of has made sure that those few businesses that he or she owns, that he or she really understands, are domiciled in strong, long-term growth industries. Am I right, Mr. Chris?
Yes.
3 out of 5. Remember, it's a low probability that I'm going to get 5 out of 5. Chris, I'm sure that person you're thinking of, and ladies and gentlemen, I'm sure the person you're thinking of, created his or her wealth in addition to owning a few high-quality businesses that he or she really understands, that are domiciled in strong long-term growth industries. That person has used other people's money to have created wealth. Am I right, sir? How would I? 4 to 5 in any university dean's honors, right? But I have to get it 5 out of 5 right because I don't want to be speculating with my client's money. So it has to be bang on. And lastly, Chris, that person you're thinking of created his or her wealth by simply holding those few high-quality businesses for the long run. Am I right, Mr. Chris? Why are you so reticent? Why are you so reticent? Eh? You're just trying to throw me off, aren't you? You're a bugger. Okay, so right, ladies and gentlemen, did I hit it right on with the person you're thinking of? So how would I have read all your minds simultaneously? How? How is that possible? That you're all thinking the same way? I'm not a mind bender. Oh, you're all thinking the same person. Who is that? Okay. So, ladies and gentlemen, so that was my eureka moment in 1977, 78. So I thought to myself, if that is the case, if everybody I know, everybody in the world who has created wealth did it this way, what should I be selling to my clients? What? Principles, a philosophy. Am I right? So the first conversation we should be having with our clients would be what? Huh? If they are saying to you, Ms. Advisor, you're an advisor? Mr. Advisor, they're saying to you, Mr. Advisor, create wealth for me. Shouldn't you immediately say, here's how wealth is created. 1, 2, 3, 4, 5. Whoa! How many advisors in Canada could rattle it off as quickly as that? How many? Not very many. Right? Because we're not thinking about wealth creation. So now, immediately, you're distinguished and differentiated. So all we now have to do is to make sure that the portfolios we build, the products we select, meet those 5 criteria. Isn't that so? So you define the criteria as to how wealth is created, the framework, the sound intellectual framework that Mr. Buffett mentioned, and then we just simply have to find products and build portfolios that are on side of those 5 criteria. Simple. He also said, what I do is simple, not easy. So the concept is simple, not easy to execute day in, day out. Right? The concept is simple, not easy to execute day in, day out. So all of that is background. So I thought as a young man now, every time I sit with a client, I'm going to make sure the first conversation that we have is, here's how wealth is created in all corners of the world. And we're not going to violate it because we're not about to reinvent the wheel. Does that make sense? So here's how ridiculous our world is. And here's how we accept dysfunctionality as a matter of course. All of us. So, but once you've defined a framework, it's easy to see black and white. If you have no framework, it's difficult to see black and white. So now so I was selling mutual funds, right? I was knocking on doors selling mutual funds for investors group. Then I moved to an independent, Regal Capital Planners. And I thought to myself, the mutual fund product is sold all over the world, right? And when clients, no? Yes. You didn't know that? My gosh. You're going to put me to sleep. So the mutual fund product is sold all over the world. And when a client buys a mutual fund, what is the client expecting? What? Eh? No, the client is expecting to create wealth. That's what the client is expecting. So if the mutual fund products that are being sold, the expectation of the product is that the product will create wealth for the clients. That's the only reason why the client is going to invest in anything to create wealth. If that is the expectation, let us now see whether the product itself has any resemblance to how wealth is created. Let's see. Is that a good fear exercise? So let's see. Your typical mutual fund, which I'm going through with you, was the analysis I was doing at age 26, 27. Because I'm not just going to enter a business and be willy-nilly and arbitrary. So I thought, and I questioned everything. I love to ask questions. So Chris, watch out. So the mutual fund product then is the same as now. The centerpiece of decision-making is diversification, right? So your typical mutual fund would have 100, 150 different stocks, right? Typical. So I thought, okay, wealth is created by owning a few high-quality businesses. Superimpose what the mutual funds are doing against that first criterion. What is the result? Positive or negative? Does it pass or fail? Fails on the first count. Oh my gosh, this isn't possible. That we could have an entire industry selling this product, regulated, and it fails on the first count relative to how wealth is created. No, this must be wrong. This could never be. So let's go to the second criterion. Wealth is created by making sure that what you own, you really understand it. Right? Right, Chris? So, if you own, a mutual fund has 100 different businesses. Is it possible to understand 100 different businesses, ladies and gentlemen? Any business owners in this room? They'll tell you how difficult it is to understand one, much less 100. Unless these mutual fund managers are from Mars with superior brains, I don't know how they do it. So if you don't understand what you own, what are you doing? Are you investing or are you speculating? So does it fail or pass on the second count? It fails. This is the mutual fund that everybody buys. Thirdly, the third criterion is wealth is created by making sure what you own, the asset you own is domiciled in a strong long-term growth industry. A mutual fund has 100 different companies. Some will be in good industries, mediocre industries, bad industries. It's diversified. Why would a rational person go out and buy a business in a bad industry? But that's what you get. So does it fail or pass on the third count? No way. It could never fail on the third count. 0 to 5? No way. And you have a whole cadre of people selling it, and a whole mass of people buying it, and you have regulators regulating it, and think that is good, reasonable. But it fails on the 3 counts so far, relative to what investors want. That doesn't make any sense, didn't make any sense to me. Fourthly, the fourth count is wealth is created by using other people's money prudently. If you own 100 different businesses, are you absolutely sure that you have 100 prudent CFOs, chief financial officers? Are you sure? Can you be sure? If you own 100, you don't know. And if you're not sure that you have 100 prudent CFOs, what are you doing? Are you investing or are you speculating? So does it fail on the fourth count? Pardon me? Could never. And lastly, wealth is created by holding for the long run. Wasn't that the fifth one? Your average turnover rate for a mutual fund is 80% a year, meaning the average hold period is 14 months. I don't know one business person in the world who buys and sells his or her businesses every 14 months. So it fails on the fifth count. So my conclusion is we have a dysfunctional industry. The product itself is not addressing clients' needs because it fails relative to the yardstick, the sound intellectual framework as to how wealth is created. Please, ladies and gentlemen, am I way off here? Am I way off here? So the key is define your framework. So what is the framework that I'm working with? Am I working with when a client sits with me? We have to have a framework. Okay, so I started off by saying that if we're going to build a long-term sustainable business, we have to do 3 things very well. First is to build a reputation. Second is to differentiate yourself. And the third is to what? Really address clients' needs. Really address clients' needs. I just pointed out that we have an entire industry of securities advisors selling these products that have no resemblance to how wealth is created. It's dysfunctional. So I thought, I'm not going to be a part of that dysfunctionality. I'd be stupid. So I went out as a young man, and I thought to myself, if that is the case, and when the highest form of leadership is to lead by example. So at age 32, I thought I have clients, and I have to make sure that my ambition was to be my largest client. That was my ambition from the get-go. So when I sit with a prospect, the client knows, the prospect knows, I don't need his or her business to put my children through university, right? Therefore, they'll have confidence in me. So they know I'm not going to do anything with their money to benefit me first. So my ambition was to become my largest client. Therefore, if that is the case, I had to make sure that I walked the talk. And the talk was the 5 criteria of how wealth is created. So let's start off with, what is the business that you would think that as a young financial mutual fund salesman, the business and industry that I would most understand? If understanding is a hallmark of a good investor, what industry do you think is the one that I'd have the most confidence in investing in? Which one? My own industry, right? The mutual fund industry. So I went out in 82, 31 years old, and borrowed $500,000. 81, how long ago was that? 32 years? 32 years ago, borrowed $500,000 to put into one stock. Mackenzie Financial Corporation. Anybody ever heard of Mackenzie? So I bought 1% of Mackenzie at age 31. On board money, $500,000. Because I had to, if you have a framework that you believe in, show some commitment. That was my commitment. Long and short of it, the stock went from $1 to $7 in 3 years. So 500,000 became 3.5 million. That gave me my financial base, but more importantly, my philosophical base. Then I started the mutual fund AIC Advantage Fund, which is the only mutual fund I know of, even today, this was back in 87, that has only 15 stocks. And 60% were mutual fund asset management companies, which I understood. So, getting back to, if we want to have a sustainable career, Mr. Buffett said, have a sound intellectual framework and make sure that you stick to the framework. That business, as the introducer said, grew to $15 billion. Simple premise, simple framework, right? Recognizing an inefficiency, a dysfunctionality, and having a commitment to not be a part of that and do something that is rational. So, I'm going to bifurcate this audience into dealers and advisors. Reasonable? So the dealers have a responsibility to provide advisors with products that will create wealth for clients. Am I right? Isn't that so? Dealers have a responsibility to provide advisors with products that will not embarrass them. Am I right? Yes? No? So, therefore, would it make sense then for every single product that your gatekeeper sees or approves should go through some intellectual framework? Eh? Do you know of a better framework than the 5 laws that I just went through? Does anyone know a better one? If you know of a better one, please tell me. I'm a student of wealth creation, and I'd love to know. This is the best one I know. So if you know of a better one, tell me, and I'll change tomorrow. Do you know of a better framework than that? So if clients are saying, create wealth for me, dealers, therefore, have a responsibility to make sure the products, every product that gets through the gate, meets those characteristics. The products should be high quality, an investment in a high quality business. And we shouldn't be compromising on what quality is. High quality isn't just Ontario quality or Canada quality. It should be world quality, right? Secondly, the product should we should make sure, let me just go through the list. Does it meet those criteria? So what that would do, it would automatically get rid of ventures. Automatically, if you have those criteria. Because ventures are truly high risk. And you don't need to take high risk to create wealth. So it would automatically get rid of ventures. So that's from the dealer standpoint. We should have a sound intellectual framework for creating, for vetting products, because if not, we're going to be making decisions arbitrarily. And I just gave you a list that every product should meet those criteria. From an advisor standpoint now, again, remember, the clients are saying, please create wealth for me. I just went through the philosophy of the 5 laws. Then, so I was going along quite happy as an advisor, selling clients on the philosophy of the 5 laws, making sure that they were on side of those 5 principles. And then we all got ambushed by the global financial crisis. in 2008. But in 2007, I'd sold a business, Berkshire. Berkshire, I started from 0 and grew to 1,000 advisors across 300 offices in Canada. From 87 to 2007 in 20 years. When I sold it, we had $13 billion. So I sold this business to a large financial conglomerate. So I thought, I was always an entrepreneur. So I thought, now I don't have to worry on Fridays about meeting payroll. Anybody has a worry in this room? Right? We entrepreneurs know it, right? So now I don't have to worry about meeting payroll. I have this stock from this global financial organization, publicly traded. And the stock price was $39.15. I got in August of 2007. So I felt great. I said, okay, 2007, by May the 2nd, 2013, nearly 6 years later, at 12%, that stock should double. So 39.15, let's say 40, should be worth $80. And the dividend should also double, so I'll be rolling in dough. Those were my expectations then. The reality is, remember, this was August of 2007. A year and 2 months later, we were all ambushed by the global financial crisis. And that stock, instead of going, it's up, it went from 39.15 to 9. And the dividend was cut in half. So I had to keep working. So I don't get paid to speak, okay? But I still had to keep working. So luckily, I just didn't only take back stock as the consideration for selling Berkshire. I took back some cash. So I took this cash and teamed up with this entrepreneur from Halifax, Nova Scotia, prominent Canadian entrepreneur. His name is John Risley from Clearwater Seafood. Anybody has heard of John? Okay, so we teamed up together and we started this business by the name of Columbus Communications. You ever heard of Columbus? How would you have heard of Columbus? John was a client? Oh my gosh, what a small world. So you know of the Columbus history. So we teamed up. You've known John for 20 years. So John and I teamed up in 2006. And the first asset we bought in Columbus, now remember, we are well stewarded, are steeped in those 5 laws. So we're only going to buy great businesses that we understand, etc., etc. Or we think we understand. So the first asset we bought was an undersea fiber optic network. That Motorola, this was in 2006, Motorola, 2006, 2007, had spent in the late 1990s, early 2000s, $450,000 laying 17,600 kilometers of undersea fiber. So it goes from Boca Raton, hops to Mexico, and every single Central American, South American country up the Eastern Caribbean passes Trinidad, the small islands of the Eastern Caribbean, Barbados, Dominican Republic, U.S. Virgin Islands, back to Miami. A ring, right? 17,600. And within the ring, you had rings within the rings. So it was like a road network, not just a highway. So this business was supposed to, when Motorola, they're in 25 countries. When Motorola decided to get into this business, the expectation was that they would sell broadband. But when it was operationalized, there was not enough broadband traffic. So this was like the road network to transport the broadband traffic. Because if you're in Colombia, as an example, and you send an email message to your neighbor, the signals don't just go from 1 Reynolds Street to 2 Reynolds Street. It goes from 1 Reynolds Street up to Miami, which is a hub, and back to 2 Reynolds Street. So that highway is our network, or is Motorola's network then. So at the great idea, poor timing. When they operationalized it, it went bankrupt. So in 2006, 2007, John Risley and myself co-founded this business and we bought it. They spent $450 million laying it. We paid $80 million for it. And we spent $20 million rehabilitating it. Today, that business generates $100 million per year in cash flow. right? $100 million per year in cash flow. That business, that's our wholesale business. Then we have, on top of that, a retail business, which is a cable business. And we thought, you know, a great business, but it's kind of late in developed countries, would be the cable business. If you could go back, rewind the clock 40 years ago, and be like Rogers 40 years ago. Wouldn't everybody love that? But you can't, that movie has already played out in Canada, where it is now playing out in elsewhere in the world, where it's fragmented. So we saw that, so we went and we started this retail Rogers in the Caribbean. That business, that retail business, gives us cash flow of another $100 million. So the business we started back in 2006, 2007, gives us $200 million in cash flow. Now, getting back to the crisis. And it's from a shareholder standpoint, all of us shareholders, and the shareholders would include the Risley Group, which would include John, the Michael Dell Foundation, and Goldman Sachs, and the Portland Group, which would include Portland Holdings, and a fund of funds that a private equity fund that we manage, that would have Canada, EDC, Export Development Corporation, as our limited partner, the United States Treasury, OPIC, as our limited partner, Verizon Pension Fund, the European Investment Bank, so we have as our limited partner. So that was our shareholder group. So we all got shares in 2007 at $1 per share. Remember, for $39.15, $1 per share. In 2009, 2 years later, we got a dividend, 50 cents per share. So our average cost is now 50 cents. So, and there was not one day during the crisis with regards to Columbus that I got up and thought, is it going to be a red day or a green day today? Not one day. I knew that every day we had more subscribers signing up, therefore cash flow is going to be greater at the end of the month when I get a report. Right? So, at the end of the crisis, I summarized, I started looking back. Because if we don't learn from history, we're going to repeat the mistakes of history. So I thought to myself, wow, the assets that got me through the crisis a little, it was difficult, but it made it a little less harsh, were not my publicly traded companies. They were my private businesses. My publicly traded companies, as represented by that 39 stock, went from 39 to 9. This business, and it gave me headaches every day because watching it going down. Looking at CNBC and hearing, oh, the stock market is down 700 points again. And I'm looking at my stock and it's going down. As I said, there was never one day that my private business gave me those ulcers. So I thought to myself, oh my gosh, I pride myself on leading by example as an advisor. Yet still, what did I do to my clients? What did I do to my clients? Because my clients, because of my advice, they all have 100% publicly traded securities or funds. Because of my advice, I felt awful. Because my situation was different from theirs. Are you with me? So I thought, I'm going to do something about it. Because then I started thinking, you know, it takes sometimes an event for you to sit up and really think about, become situationally aware. Then I started really thinking. I thought to myself, wealthy people, wealthy entities, Ontario teachers, CPP, the uber wealthy amongst in our society, are their portfolios comprised of 100% publicly traded securities? Yes or no? No. The rest are rest who are advised by a securities industry advisor. Are their portfolios comprised of 100% publicly traded securities? Yes or no? Yes. But why should that be the case? Why? Can anyone give me an answer? Why? Yes, sir. Eh? It's a place to sell the private. Exactly. It's a place to sell the private security. So no one can give an answer, a rational answer, as to why my portfolio should be 100% public. But I was behaving like that all along until the crisis came and made me think. So I wasn't thinking before. I was a lemming. So I thought to myself, unto your teachers, what's the mix between public and private? 50-50. Yale Endowment Trust, what's the mix between public and private? 20% public, 80% private. Yale isn't stupid. Harvard Endowment Trust, what's the mix between public and private? 20% public, 80% private. CPP, if we live long enough, we'll collect from CPP, hopefully. What's the mix between public and private? Huh? It's not 100%. So the question is, to finish the circle, if the needs of CPP yield unto your teachers' owners are the same as our clients' needs, which they are, protect capital, get growth, get income, right? If the needs are the same, shouldn't the portfolio profiles be different? Or should the portfolio profile be different, or should the portfolio profiles be the same? Same. So tell me, ladies and gentlemen, who do we know whereby clients can go and get that type of portfolio composition? Who does that? Who does that? We do. Exactly, the EMD dealership. So we, therefore, we the EMD dealerships, we, although the public is looking on at us and thinking we are inferior to the IROC dealers, right? That's what the public is thinking. But they don't realize that we are the ones who can give them a portfolio that mirrors onto your teachers or CPP. Am I right? So, therefore, it behooves us as advisors now. It behooves us as advisors, when we have a conversation with our clients, the conversation has to be holistic. The first conversation, in addition to how wealth is created, second conversation should be, tell me, clients, what percentage of your portfolio should be liquid versus illiquid? What percentage? And let's go through it. Let us do a personal financial review and come to some decisions. But one thing is for sure, 100% should not be liquid. That's for sure. So first conversation, second conversation is, what percentage of your portfolio should be liquid versus illiquid? And the client is going to say, I've never heard, an advisor has never asked me that before. Which advisor has asked that question? No advisor does that. So you'll immediately distinguish yourself. So we have to be thinking portfolio construction and portfolio profile because it makes our job easy. Right? So now I started thinking about the concept of public versus private businesses even further, drill down a little deeper. And I thought to myself, let us look at your typical private business. Because, by the way, that's where wealth is created. Wealth is created in private businesses, not in public businesses, really. The growth of the wealth, generally speaking. Right? You have much more wealth being created in private businesses than public businesses. So let us go through that. Your typical private business owner would have the majority of his or her net worth in his or her business, right? The majority of his or her net worth in his or her business. Am I right? So that typical business owner has skin in the game that he or she had to pay for. It wasn't given as options. Right? And worries about it. Exactly. So skin in the game is the important thing here, which ties every big private business owner together. So when decisions are made, invariably, that business owner is the CEO, chairman, and chief bottle washer. Am I right? Invariably, that business owner is an autocrat. There's no democracy here. Am I right? An autocrat. Because people can give advice and chime in, but it's his net or her net worth that's going to go down if the advice is bad, not theirs, if they have no skin in the game. So invariably, that person is an autocrat. Periodically, that person, that business person, and they're all around us, private owners, they have to make a capital allocation decision. So they make a profit, And their focus is making a profit. Because if they don't make a profit, they have no liquidity. So because they cannot fracture their shares and sell off 10,000 shares of a private company to get 100,000 to buy a car. They can't the shares are not fracturable, if there's such a word. Nor can they hypothecate the shares to the bank and get hypothecate 20,000 shares to get $100,000 to buy a car. They can't do that. So their focus is absolutely on profits to get liquidity. Or their children, if they don't know profits, children become skinny. So that person periodically has to make capital allocation decisions. Profits, what do I do with the profits? I can buy another plant or equipment, or I can buy another company. Right? If the decision is a good decision, that person's net worth increases. If it is a bad decision, that person goes bankrupt. Am I right? So the risk-reward ratio is perfectly symmetrical. Heads, he or she wins. Tail, he or she loses. Perfectly symmetrical. And never one day in that person's life, as a private business owner, does that person have to contend with quarterly analyst expectations. Never one day. And never one day did that person think about red day or green day or what they're doing in Greece. Am I right? Never one day did that person have his or her business marked to market every single second. Never one day. Am I right? So those are the characteristics of how wealth is created in the real world. Please, ladies and gentlemen, where am I off base? Huh? Okay, now, so let us look at the progression. So one day, after 35 years, that business person becomes tired. And a securities industry investment banker comes and says, look, you look tired. I have a solution for you. I can take your business, make it public. It's now widely held. You'll get cash for one day, and then I'll come back to you, and we're going to put a portfolio together for you. So, sounds good after 35 years. So that private business owner now sells his business on Friday. Saturday, the security salesman come back and puts together a portfolio. The portfolio is comprised of stocks, publicly traded. Pools of stocks, publicly traded. Mutual funds, fund of funds, whatever. Bonds, publicly traded. Pools of bonds, bond funds, etc., right? And the advisor said, this portfolio will give you protection against capital, give you income, give you growth. You're fine now. That was Saturday, Sunday, Sabbath day. Monday morning, first thing in the morning, what does that former private business owner, what does he or she do now? Turn the TV on to CNBC. Turns the computer on to Bloomberg and asks, is it a red day or a green day? Oh, red? Oh my gosh. Green? Wow, honey, let's go shop. So that person's mood is now determined by red or green. So you'll agree that that's a foreign situation given the prior 35 years. So we as securities people, that's what we do to clients. Right? Am I exaggerating here? So now, let us look at the portfolio that that person now has and compare it to what that person had. So first thing is, under the auspices of good corporate governance, we need a board. And the board has to be majority independent. Now, which sane private business owner would want independent people who know nothing about his or her business to come in and have a say in the future of the business? Which sane private business owner would do that? Any? But that's under the auspices of good corporate governance that is common to every single publicly traded stock. So then you say, who are these board members? Who are they? Have they ever had to suffer the pangs of Friday? Ever? No. Invariably, they're accountants, lawyers, ex-politicians. Am I right? Invariably. So, and by the way, how much skin in the game do they have? How much? Zero. And by the way, do you make different decisions when you're committed versus when you're not committed? So we have a totally different situation here. So that's at the top of the house, board of directors. Then you have various management committees. Compare that to the private business owner. He was or she was head, chef, bottle washer, sweeper, everything. No committees around here. Therefore, that business is less nimble versus the private business. Periodically, the public company, management, comes up with a great idea. They're going to buy a new plant or make an acquisition. If the acquisition works out, if it's a great decision, management gets a bonus. If it's a bad decision, they get half the bonus. If it's a really, really terrible decision, they get a golden parachute. It's tantamount to flipping a coin. Heads they win, tails they don't lose. Please, ladies and gentlemen, where am I wrong? Where? So, then, to make it more dysfunctional, we have the situation where every quarter the analysts line up and say, company X, your earnings this quarter will be Y. And if it's 1 cent less than Y, I'm going to write a bad report, punish your stock is going to go down, and you're going to be embarrassed. And your net worth is going to go down. So management now doesn't want its stock to go down. So what does management do? Listen to the analysts. Then you say to yourself, where did the analysts get the information from? From management. Did management, or not even management, the IR department, investor relations department. Do you think the investor relations department gave the 100% of all the information pertaining to the company? No. So now we have this, what they do, analysts do, get the information, put it on a spreadsheet, linearize it, and say next year, the third quarter, it must be Y plus 3%. Right? What in life is linear? Anything? Your relationship with your spouse? Is it linear? Huh? Nothing in life, yet still this complicated beast in a complicated world is being linearized. So management now listens to, even more ridiculous, management listens to the analysts. Now, so we, securities industry, we take that private business owner from the solitude of the world that he or she created wealth in and put that person in this mayhem world of red and green. That's what we do as securities advisors. Please, ladies and gentlemen, shouldn't there be a better way? Wouldn't it make more sense if we could put together portfolios that reflected more of the characteristics that those business people were used to when they were creating wealth than this red day, green day portfolio? Wouldn't that make more sense? Who does that? Who does that today? Nobody does that. And because nobody does that, what does that do for us if we target the accredited investor? What value added can we bring to the accredited investor? Can we not bring the ultimate in terms of portfolio construction? Can we not do that? Pardon me? So, the securities advisor, the IROC advisor, really is constrained. We are unconstrained right now with the right client. So the question is, given that we have the opportunity to really put together portfolios that are very pension-like in their profile, shouldn't that be our thrust towards clients when we're trying to procure clients? Because nobody else is doing it. Shouldn't that be? So, ladies and gentlemen, as a former mutual fund salesman, I was always thinking prospecting. Prospecting I have because prospecting is my lifeblood. Am I unique? Do you think that way? Huh? Prospecting is my lifeblood. It is today a fantastic opportunity that we have as advisors in the EMD industry, focusing on the accredited investor for now, which is another issue as to why that should be the case. It's an opportunity that we have as advisors, as dealers, to really rise to the occasion, recognize that we are in a unique position in the advice giving space, we're in a unique position. We now have to step up by the dealers, or dealers have to step up by making sure that the products that we put in the hands of our advisors are of the quality that clients will be proud. We advisors, that's it from dealer's standpoint, we advisors have to step up in terms of the value-added services that we're giving to clients. And at the end of the day, we should be constructing portfolios that are no different in profile or quality than on-tier teachers. No different in profile or quality than on-tier teachers. So we're at a great point in the in the advice-giving universe. We have a unique niche. We're focused because our clientele is defined for us. When we sit with a client, we can provide, once we have the requisite products, we can provide full planning, full portfolio construction, and if we're doing any less, we're abusing our wonderful opportunity. Thank you very much.